Welcome. For those of you looking to really deepen your understanding of how finance is evolving, you're definitely in the right place today.
Absolutely.
We're going to unpack a topic that's, well, it's fundamentally reshaping the financial landscape.
It really is.
We're talking about environmental, social, and governance ESG, and how these considerations have shifted from being, a niche concern to something absolutely central for financial institutions.
A core imperative, really.
Exactly. And we'll explore its impact across sort of three main areas: investment strategies, lending practices, and crucially, risk management. Oh, and by the way, something important for your professional development after listening to this: when you take the quiz, you can earn your CPD certificate. That's half an hour of credit right there.
That's great.
So let's get started on this fascinating journey.
Yeah, and what's truly compelling here, I think, is that the demand for more transparency, more accountability, it's coming from all directions. Regulators, clients, even employees are pushing for it. So this isn't just about, ethics or doing good. It's really about defining and managing value, risk, and opportunity in a world that's changing incredibly fast. It's a fundamental shift. You just can't ignore it anymore.
Okay, so let's start with the basics then. What is ESG integration, really? We hear the term all the time. It sounds like a big buzzword. What does it actually mean day to day for finance professionals?
Yeah, good question. At its heart, it's about systematically and explicitly including these environmental, social, and governance factors right into your financial analysis and decision-making.
Okay, so bringing those factors in.
Exactly. And the key thing is it's not about replacing traditional financial analysis. Think of it as enhancing it. You're looking at factors beyond the typical balance sheet that can genuinely, materially impact a company's long-term performance and its risk profile.
Can you give some concrete examples, like for each letter, E, S, and G?
Sure. So for environmental E, you're looking at things like climate change impact, a company's carbon footprint, resource depletion, maybe water usage, waste management, biodiversity impact.
Okay.
For social S, that covers labor practices, how a company engages with its community, diversity and inclusion within the workforce, human rights issues, especially in supply chains.
Right, the people side.
Exactly.
Yeah.
And then governance, G, is really the nuts and bolts of how a company is run. Think board composition, diversity on the board, executive compensation, transparency in reporting, shareholder rights, that kind of thing.
Got it.
The core idea, the real insight, is that these so-called non-financial factors can have very real, very tangible impacts on a company's financial health and its long-term viability.
That makes perfect sense, enhancing, not replacing. But I can imagine some traditional finance folks might still be thinking, okay, fine, but is this just another layer of complexity? Does it genuinely add value beyond the traditional numbers?
It absolutely adds value. And, what's really driving it now, beyond just good intentions, is this huge push from regulations. It's becoming non-negotiable.
Ah, the regulatory stick. So it's clear these factors are important, but I'm curious, what's maybe the biggest regulatory framework out there right now that institutions globally just have to pay attention to?
Globally, one of the most impactful has definitely been the Task Force on Climate-Related Financial Disclosures, or TCFD.
TCFD.
Yeah. And its real power isn't just asking for disclosure. It's making companies actually quantify climate risk, not just as some environmental issue off to the side, but as a core financial risk, something that impacts the bottom line, investor decisions. That shift in perspective is crucial.
Okay, so TCFD is about disclosing the risks. What about setting actual standards for what sustainable means and how you report it consistently?
Right. That's where the International Sustainability Standards Board, the ISSB, comes in. They've released IFRS S1 and S2.
IFRS S1 and S2?
Yes. And the goal here is to create a global baseline for reporting on sustainability and climate issues. The true insight, I think, is that by standardizing this, the information becomes genuinely comparable for investors across different companies, different markets. That really boosts transparency.
That comparability piece sounds critical for investors.
It is. And beyond these global standards, regional developments are also picking up pace, big time. In Europe, for instance, you've got the EU Sustainable Finance Disclosure Regulation, SFDR.
SFDR, yes, I've heard a lot about that one.
It essentially defined how financial market participants have to disclose the ESG risks they're integrating. It even categorizes products Article 6, Article 8, Article 9, based on how ambitious their sustainability objectives are.
So investors know what they're getting.
Precisely. From basic risk consideration up to funds where sustainable investment is the main goal. And then there's the EU taxonomy regulation, which gives this clear science-based definition of which economic activities actually count as environmentally sustainable. These two together are really shaping product design and marketing in Europe.
Wow, Europe sounds like it's really leading the charge with that level of detail. Are we seeing similar pushes elsewhere?
We certainly are, though maybe structured differently. Beyond direct government regulation, you have these really powerful industry-led commitments. Think of the United Nations Principles for Responsible Investment, the UNPRI.
Ah, yes, the PRI.
It's become a de facto standard.
Yeah.
I mean, over 5,000 signatories have committed to integrating ESG. There's huge market influence. And then you have industry alliances like the Net Zero Banking Alliance, NZBA, or the Asset Manager Initiative, NZDMI, getting institutions to commit to net zero emissions targets by 2050. These aren't just rules, they create market expectations.
So it's regulation, but also peer pressure, in a way.
Absolutely. And it's not just a global north thing either. Look at South Africa, for example. Regulation 28 of the Pension Funds Act explicitly requires trustees to consider ESG factors now.
Regulation 28. Okay.
The Financial Conduct Authority, the FSCA, has issued guidance encouraging sustainability risk consideration. And the Johannesburg Stock Exchange, JSE, requires listed companies to report on specific ESG metrics. Even regional bodies like the African Development Bank are pushing ESG initiatives.
So the message is pretty clear then.
It really is. This signals a fundamental shift. Sustainability isn't some voluntary add-on anymore. It's a regulatory and strategic requirement, pretty much everywhere.
That really paints a picture of why this is unavoidable. But okay, the big question for many listeners is probably, all right, I get the why, but how? How are institutions actually doing this? Making it actionable, especially when it comes to investment decisions?
That's the million-dollar question, isn't it? And there isn't just one way. It's more like a spectrum of strategies.
Okay.
So at one end, you have what's called negative or exclusionary screening. This is pretty straightforward. Investors just exclude certain companies or whole sectors based on ethical or ESG criteria. Think tobacco, maybe controversial weapons, or sometimes fossil fuels.
So just drawing a line.
Exactly. It's clear, often driven by values, but some see it as a bit reactive, maybe not driving change proactively.
Okay, what else?
Then you have positive or best-in-class screening. Here, instead of excluding the worst, you actively favor companies that are ESG leaders within their specific industry. So you might invest in the energy company with the best carbon reduction plan, or the retailer with top marks for workplace diversity, rewarding the leaders.
Right, encouraging good behavior.
Then it gets more sophisticated with full ESG integration. This is where you're really embedding ESG factors directly into your traditional financial analysis and valuation models.
How does that work in practice?
Well, you might analyze how a company's water usage strategy impacts its operating costs, or how strong governance might reduce its risk profile. This can actually affect your assumptions about future cash flows, the company's competitive position, even the discount rate you use to value it.
So it directly changes the financial calculation.
It can, yes. A company with strong climate resilience might be seen as less risky, get a lower discount rate, and therefore a higher valuation. And finally, you have thematic and impact investing. Thematic targets specific themes like clean energy or sustainable agriculture. Impact investing goes a step further, actively seeking measurable positive environmental or social outcomes alongside a financial return. Think projects aligned with the UN Sustainable Development Goals, for example.
That's quite a range of approaches, and presumably they need some pretty specific tools and frameworks to actually implement these strategies, right?
Oh, absolutely. They lean heavily on ESG ratings and data providers, names like MSCI, Sustainalytics, S&P Global, ISS ESG probably sound familiar. They provide benchmarks and data points.
But I've heard that data can be inconsistent.
That's a major challenge. The methodologies between providers can differ quite a bit, leading to different ratings for the same company. Because of that, many larger institutions are developing their own proprietary ESG scoring models.
Ah, doing it in-house.
Exactly. They create internal scorecards, weighing specific metrics like carbon emissions, board diversity, or supply chain transparency based on what they deem most important for their strategy.
You mentioned materiality mapping earlier in the outline. Could you just simplify that concept for us? What does that mean in practice?
Sure. Think of it like focusing your attention where it matters most financially. For a tech company, data privacy and security are hugely material ESG issues. A breach could be catastrophic. But for an agricultural company, water usage and soil health are probably far more critical to their long-term success.
Okay.
So materiality mapping, often using frameworks like SSB's standards, helps a company or an investor identify which specific ESG issues are most likely to have a significant financial impact for that particular industry. It stops you trying to boil the ocean and focuses effort.
Got it. Focus on what counts for that business.
Precisely. And increasingly, we're seeing scenario analysis and climate stress testing. This involves modeling the potential financial impacts of different climate change scenarios, like a 1.5 degree C warming pathway versus a 4 degree C hothouse world, on asset values, loan portfolios, carbon pricing impacts, regulatory shifts. It's about understanding future risks.
Can you give us a real-world example just to bring this to life?
Certainly. Think about a large European pension fund. We've seen cases where they've undertaken a major portfolio rebalancing. They might divest from companies heavily reliant on thermal coal, significantly increase their holdings in green bonds, and simultaneously engage actively with the remaining companies in their portfolio, pushing them to set clear, science-based emissions reduction targets.
So divestment, investment, and engagement.
A combination, yes. Or think about private equity. It's now pretty standard for PE firms to conduct really thorough ESG due diligence before they even acquire a company. They'll use their own toolkits to assess environmental liabilities, potential social risks like labor issues, and governance weaknesses.
And after they buy.
Then they often build specific ESG key performance indicators, KPIs, directly into their value creation plan for that company. Things like reducing waste, improving safety metrics, or increasing board diversity become part of how they measure success and improve the business before they eventually exit.
Those are great examples. They really show it happening on the ground. But back to that key question. Does this actually pay off financially? Is there solid evidence that ESG integration helps rather than hinders financial performance?
Yeah, it's the critical question, isn't it? And the evidence is really mounting. More and more studies suggest that yes, ESG integration can improve long-term risk-adjusted returns.
How so?
Well, a big part is risk mitigation. ESG factors often act like early warning signals. Think about it. Poor governance is frequently linked to corporate scandals and fraud. Environmental negligence can lead to massive fines, cleanup costs, and reputational damage. Social risks like poor labor practices can cause strikes, lawsuits, or consumer boycotts. Spotting these risks early is valuable.
So avoiding the downside.
Exactly. And beyond just avoiding bad things, strong ESG practices often lead to enhanced resilience. Companies that manage resources efficiently, have good employee relations, and are governed transparently tend to be more adaptable, more stable, especially when markets get volatile or regulations change.
Okay, that makes intuitive sense. Is there academic backing for this?
There is, quite a bit actually. Studies from places like Harvard Business School, Oxford University, and many others have found correlations between high ESG ratings and positive financial outcomes. Things like a lower cost of capital, better operational performance, and stronger stock price performance over the long run.
Interesting.
But, and this is crucial, it's not magic. ESG insights work best when they're combined with rigorous, traditional financial discipline. It's about adding another layer of intelligence, not throwing out the fundamentals.
Right, enhancing, not replacing. So that covers the investment side quite well. But as you said, it's not just about investing money, it's also about lending it. How are banks and other credit providers bringing ESG into their lending decisions?
You're absolutely right. The lending side is seeing a parallel transformation. Lenders are increasingly realizing that ESG risks aren't just out there risks. They can directly hit a borrower's ability to repay their loan, their creditworthiness, especially over the medium to long term.
So it's becoming part of standard credit risk assessment.
Yes, very much so. ESG considerations in credit risk assessment now involve looking critically at a borrower's exposure to environmental risks, things like their vulnerability to climate change impacts, water scarcity issues, potential pollution liabilities, or how upcoming regulations like carbon taxes might affect them.
Okay.
And you have social risks, labor relations, health and safety records, community impacts, and governance risks, weak board structures, lack of transparency, maybe a history of corruption or bribery.
Can you give an example of how that might play out?
Sure. Imagine a manufacturing company with a poor track record on environmental compliance. They might face hefty fines, potentially need to invest massively in upgrades, and suffer serious reputational damage. All of that directly impacts their cash flow and their ability to service their debt. A lender needs to factor that risk in.
That makes sense. And are we seeing new types of loan products emerging from this?
Definitely. There's been a real growth in innovative products like ESG-linked loans and green lending.
Okay, what's the difference? Let's start with green loans.
Green loans are pretty specific. The loan proceeds have to be used exclusively for clearly defined green projects. Things like building a wind farm, installing solar panels, funding energy efficiency upgrades, or developing clean transportation. There are established frameworks, like the Green Loan Principles, GLP, that guide the use of proceeds, project eligibility, and require reporting on the environmental impact.
So the money is earmarked for a green project.
Exactly.
And how does that differ from a sustainability-linked loan? They sound quite similar.
It's an important distinction. With sustainability-linked loans, SLLs, the loan isn't tied to a specific green project. Instead, the loan terms, usually the interest rate margin, are linked to the borrower achieving predefined, ambitious ESG targets for their overall business.
Ah, so company-wide targets.
Right. These targets, or key performance indicators, KPIs, could be things like reducing Scope 1 and 2 greenhouse gas emissions by a certain percentage, increasing the proportion of women in senior management, or improving workplace safety metrics. If the borrower meets these pre-agreed KPIs, they might get a discount on their interest rate.
A direct financial incentive.
Precisely. It incentivizes genuine, holistic ESG improvement across the borrower's operations, not just funding one green project. We're also seeing the emergence of transition finance. This is specifically aimed at helping companies in high-emitting sectors, think mining, cement, aviation, finance their shift towards more sustainable operations. These often come with very strict conditions and targets.
That sounds crucial for decarbonizing those harder-to-abate sectors.
It really is.
Yeah.
And beyond specific products, we see sector-specific approaches too. Banks are applying much tougher scrutiny to high ESG risk sectors like oil and gas, coal mining, or certain types of agriculture. Some are even publicly phasing out financing for new coal projects, for example.
So higher hurdles for some sectors.
Yes, and conversely, sectors seen as inherently sustainable, like renewable energy or certain healthcare areas, might get preferential access to capital or more favorable lending terms.
Can you share an example of an SLL in action?
Yeah, there was a notable case with a large South African retailer. They secured a R500 million SLL where the interest rate was directly linked to KPIs covering carbon footprint reduction from their operations, increasing their renewable energy usage, and metrics around employee well-being. Hitting those targets meant a tangible margin reduction around 25 basis points, I believe. That's a real incentive.
That is a powerful incentive for change. Looking beyond just managing the risk side, what are the broader strategic benefits for banks and lenders engaging in this type of ESG-focused lending?
Oh, the benefits are multifaceted. Firstly, there's a huge boost to reputation and stakeholder trust. Demonstrating responsible financing practices resonates well with clients, investors, regulators, and the public.
Good PR, essentially.
It's more than PR, it builds genuine trust. Secondly, it can improve access to capital for the bank itself. Increasingly, large institutional investors and development finance institutions prefer to provide capital to banks that have strong ESG frameworks and portfolios. You might even get access to concessional finance lines specifically for green or social lending.
Interesting. What else?
This is clear regulatory alignment. As disclosure rules around climate risk tighten globally, having these practices embedded makes compliance much easier and positions the bank ahead of the curve. And importantly, it fosters innovation and deeper client engagement. Developing these products requires understanding clients' sustainability challenges, which can lead to stronger advisory relationships and more tailored solutions. It moves the bank beyond just being a lender.
So it's risk management, reputation, access to capital, and relationship building. Quite compelling. Now, let's broaden out again. Beyond specific investments and loans, ESG seems to be fundamentally changing how institutions think about overall risk, right? It's not just market risk or credit risk in isolation anymore.
Exactly. That's a really key point. ESG risks are now firmly recognized as material risks in their own right. Risks that can genuinely threaten an institution's financial stability, its operational resilience, and its reputation.
So how do they go about identifying these sometimes less tangible risks?
It involves systematically identifying ESG risks across those three pillars. For environmental, you've got physical risks, damage from extreme weather events, sea level rise. Then transition risks, shifts in policy like carbon taxes, technological disruption favoring green tech, changing consumer preferences, and liability risks, potential lawsuits over environmental damage or pollution.
Okay, that's the E. What about S and G?
For social, risks include things like major labor violations leading to strikes or legal action, significant social inequality impacts from operations, abuses discovered in the supply chain, or poor community engagement leading to operational delays or protests. For governance, it's about weak structures, lack of board independence or diversity, inadequate risk oversight, executive pay issues, ethical misconduct, or opaque reporting that hides problems.
And these aren't always separate, are they?
That's a crucial insight. These risks are often deeply interconnected. For example, a severe climate event, environmental, might displace workers and disrupt supply chains. Social, which could then expose underlying failures in a company's crisis management and board oversight, governance. You have to look at them holistically.
So how do institutions manage this complex web of risks? Is it just bolted onto existing risk frameworks?
Increasingly, no. Best practice is about embedding ESG directly into enterprise risk management frameworks. It's not a separate silo.
What does that look like practically?
It means things like updating the official risk appetite statements to explicitly include thresholds for climate risk or social impact tolerance, conducting formal materiality assessments to pinpoint which ESG risks are most relevant to that specific institution's business model and geography.
Okay.
It also involves embedding ESG factors into core regulatory requirements, like internal capital adequacy assessment processes, ICAMBs for banks, or the Own Risk and Solvency Assessment, or RSA for insurers. ESG metrics are becoming key risk indicators, KRIs. They get regularly monitored and reported up to board risk committees. And importantly, updating risk taxonomies to ensure ESG isn't just another category, but is properly integrated across credit, market, operational, and reputational risk types.
So really weaving it into the fabric of risk management.
Exactly. And a big part of that is stress testing and scenario analysis, especially for climate risk.
We touched on that for investments, but how does it apply at the enterprise level?
Institutions are modeling the financial impact of various climate pathways. Maybe a smooth 1.5 degrees C transition, maybe a disruptive disorderly transition with sudden policy shifts, or even a hothouse world with severe physical impacts. They're assessing how these scenarios could affect loan default rates across their portfolio, the value of their assets, potential insurance liabilities, and ultimately their overall capital adequacy.
What tools do they use for that?
They often use the scenarios recommended by the TCFD or developed by the Network for Greening the Financial System, NGFS, which is a group of central banks. They might adapt their existing internal models, like value at risk VAR models, to incorporate these climate variables.
And of course, there's the risk of just not keeping up with the rules themselves.
Absolutely. Regulatory and compliance risk is huge and growing. With the proliferation of regulations like the ISSB's new IFRS S1 and S2 standards, the EU's Corporate Sustainability Reporting Directive, CSRD, South Africa's Regulation 28 we mentioned, the list goes on.
Keeping track must be a challenge.
It is. And failure to comply doesn't just mean potential legal or regulatory penalties. It can lead to a serious loss of investor confidence and significant reputational damage, especially if there are accusations of greenwashing, making misleading claims about sustainability efforts. This necessitates dedicated ESG compliance teams and integrating these requirements into internal controls and audits.
It really sounds like it needs to become part of the DNA of the organization.
That's the goal. It's about truly embedding ESG in the organizational risk culture. This involves concrete steps, like appointing a senior executive, maybe a chief sustainability officer, CSO, or a dedicated ESG risk officer, expanding board oversight responsibilities to explicitly include ESG performance and risk.
So top-down commitment.
Crucial, but also bottom-up, incorporating ESG considerations into internal audit plans, compliance functions, and providing regular, practical training for staff across different departments so they understand how ESG relates to their specific roles.
It really raises an interesting question, doesn't it? Is an organization's ability to effectively manage these complex, interconnected ESG risks becoming, in a way, a proxy for its overall strategic foresight and operational resilience?
I think that's exactly right. It increasingly signals a well-managed, forward-looking company.
Okay, this all sounds incredibly transformative, truly fundamental, but it can't be easy. What are some of the biggest hurdles or challenges that institutions are grappling with as they try to navigate this new landscape?
You're right, it's definitely not without its challenges. One of the biggest, consistently cited, is data gaps and inconsistencies.
We touched on that with ratings providers.
Exactly. Getting reliable, comparable, and comprehensive ESG data across different companies, sectors, and jurisdictions is still really difficult. Data can be incomplete. It's often not standardized. Methodology differs. It makes robust analysis and comparison quite challenging.
What else?
There are significant greenwashing risks. As demand for ESG products grows, so does the concern about misleading claims or products that don't live up to their sustainable billing. This erodes trust, and attracts regulatory scrutiny.
So the risk of looking good without actually being good.
Precisely. Another major hurdle, especially for smaller institutions or those in emerging markets, is capacity and expertise. Building the internal knowledge and skills needed to properly integrate ESG isn't trivial. Without it, you risk falling into a superficial tick-box compliance exercise rather than achieving genuine strategic alignment.
You're the right people.
Absolutely. And finally, just the sheer pace of change in the evolving regulatory landscape globally creates uncertainty. Keeping up with new requirements across different regions is complex and resource-intensive, creating constant compliance pressure.
Okay, so data, greenwashing, capacity, and the speed of regulation are key challenges. Knowing those, what's on the horizon? What future trends should we be watching out for as ESG continues to evolve?
Well, I think we can expect greater regulatory convergence over time. While there are regional differences now, efforts by bodies like the ISSB, coordinating with jurisdictions like the EU and others building on TCFD, aim for more alignment on global baseline standards, particularly for disclosure. That should eventually simplify things.
More consistency globally.
That's the hope. We'll also see technology-driven ESG analysis become much more sophisticated. Think AI analyzing vast amounts of unstructured data, satellite imagery being used to monitor deforestation or methane emissions, big data analytics identifying supply chain risks. Technology will play a huge role in improving data quality and risk detection.
Using tech to fill those data gaps.
Exactly. Another key trend is the focus broadening beyond just climate. We're seeing a significant rise of nature and biodiversity considerations. Issues like natural capital dependency, water security, deforestation links. These nature-related risks are moving up the agenda rapidly.
So beyond carbon.
Definitely. And finally, I expect we'll see more active ownership and stewardship. Investors and lenders won't just screen or integrate data. They'll increasingly use their influence through voting at AGMs, direct engagement with company management, filing shareholder resolutions to actively push companies for better ESG performance, and clear transition plans.
Using their clout as owners and financiers.
Precisely. It's about driving change from within.
Wow, what an incredible journey through the world of ESG integration in finance. It's crystal clear this is a fundamental shift, isn't it? Not just some passing trend.
Absolutely not.
We've covered how ESG is being woven into investment strategies, really shaping how portfolios are constructed now, how it's revolutionizing lending practices, creating powerful incentives for sustainable change, and how it's fundamentally reshaping risk management, becoming key to safeguarding stability and reputation. So wrapping this up, what does this all really mean for you listening in? Whether you're a seasoned financial professional or maybe just someone keenly interested in how our economy and world are changing.
Yeah, I think there are a few key takeaways. First, ESG factors are financially material, period. They need to be integrated into investment, lending, and risk decisions, not as an afterthought, but as a core component of assessing and creating long-term value.
It's just part of the analysis now.
It has to be. Second, the regulatory momentum is undeniable. Getting ahead of compliance isn't just about avoiding penalties. It builds trust, enhances reputation, and can strengthen your market positioning. Third, all this change is driving real innovation in finance, green bonds, sustainability-linked loans, new risk models. These offer exciting new opportunities.
Finding opportunities in the shift.
Exactly. Fourth, this really requires cross-functional collaboration. ESG isn't just the sustainability team's job. It cuts across finance, risk, legal, operations. Breaking down those internal silos is essential. And perhaps most importantly, given how fast things are moving, continuous learning is absolutely vital to stay relevant and effective in this field.
Constant learning, for sure.
And maybe a final thought to leave everyone with. The financial sector holds immense power and therefore responsibility in shaping a more sustainable and equitable global economy. Integrating ESG isn't just about good governance or ticking boxes. It is fundamentally sound, future-oriented business strategy. So the question for everyone listening is, how will you apply these insights to navigate and hopefully thrive in this rapidly evolving landscape?